This short video is going to tell you everything that you need to know about double entry bookkeeping. My name is Tom Clendon and I am a senior lecturer at the Hertfordshire Business School teaching on these programs. Now, double entry bookkeeping is an essential part of any accounting degree, and double entry bookkeeping can be explained, I think, fairly shortly because it is about the rules. So it's often computerized. Now, to begin with, I need to explain to you about the elements. I'll then need to talk to you about duality, one debit, one credit. And then finally, I'll need to talk to you about when we debit and when we credit. These are the basic rules of double entry bookkeeping. So let's start at the beginning with elements. Now, there are 5 basic building blocks in financial accounting. The first of which is assets. So these are good things. These are resources that we control. Land, buildings, machinery, cars, computers, cash, when people owe us money. Assets, good things. Liabilities are bad things. They're obligations, they're money that we owe. So examples of liabilities would be a bank overdraft, a loan, a trade payable, something like that. And then we have equity, sometimes referred to as capital. And this is our ownership interest in the business. A simple analogy is, if we buy a house and we buy a property for, say, £500,000, we have an asset. But if our mortgage is £400,000 and we've put our own money in of 100, we would say the asset was 500, the liabilities were 400, and the equity, the ownership interest in that property was 100. And you'll notice that those numbers balance. That's an accounting equation. That's a statement of financial position. These 3 elements always appear on our balance sheet, on our statement of financial position. Now, the other 2 elements that we have are to do with income and expenses, and they're the measurement of profit. So we take our income, which is our sales, and we look at our expenses, which is our day-to-day running costs, our rent, heat, light, wages. Every single account, every single thing in accounting is one of these 5. If it's a car, it's an asset. If it's rent, it's an expense. If it's money we owe, it's a liability. So we can categorize everything into one of these 5. Very key building block. So what are the rules then? Well, every transaction has 2 effects. So there's a yin and there's a yang. And those effects are not necessarily one up, one down. It can be both up or both down. Those effects, though, are one debit and one credit. That's an absolute essential. It's always one debit and one credit. Every transaction, 2 effects. One's a debit, one's a credit. And the convention is, I don't know why, it's what I was taught. I mean, the convention is debits are on the left and credits are on the right. And that's the way I was also taught to drive. You drive on the left because you would crash on the right. So yeah, that's the way it is. Accept it. There's nothing too conceptual to understand here. These are rules that you must follow. They are facts. So when do we debit and when do we credit? Once we've got the first decision, once you remember what an increase in an asset is, everything else is going to be logical. To increase an asset is a debit. That's the rule. Now, if I buy a property, if I pay money to buy a property, I'm increasing an asset, so I debit the asset account, debit property. Assets are very similar to expenses because they both require money to be paid. So am I buying the property or am I paying rent? Both of those are going to be debits. Whether you increase an asset, whether you increase an expense, they are debits. Assets and expenses are blood brothers. Assets and expenses are, yeah, they're tight. Opposite of an asset, liability. Now we call liabilities sometimes creditors. So it's no surprise that if assets are debits and liabilities are the opposite, liabilities are credits. Opposite of an expense, income. So income is also going to be the opposite. Income and liabilities are both credits. Now this leaves us with our fifth and our final element, which is equity, capital. Now, it's not that the business has a liability to its owner, but you can sort of say that. Equity is like a liability. It's not a liability, but it's like a liability. So we treat it as a credit. In a trial balance situation, all of your accounts, which are assets and expenses, will be debit balances. And all of your liabilities, income and equity, they'll all be credit balances. If the transaction is reducing, then you just do the opposite. Yeah. So to reduce an asset is a credit. To reduce an expense is a credit. To reduce a liability is a debit. It all started with knowing there are 5 elements, and knowing to increase an asset is a debit. Now there's another way of remembering all of this as a mnemonic, and the mnemonic is dead click. Dead click. And in the beginning, you see we've got debits, yeah, debits, expenses, assets. I haven't said what the second D is yet. Debits are expenses and assets. Expenses and assets are going to be debits. Now on the right hand side there, you've got the click, debits on the left, credits on the right. It even reinforces that. You've got your LIC, so you've got your liabilities, your income and your capital. Your 5 elements there. Now, in order to make the mnemonic work, we need an extra D, which is in the debits, and that is drawings or dividends. And these are reductions in capital. So if capital equity is a credit balance and we as an owner, we withdraw money or we pay the shareholders a dividend, then that becomes a debit. Dead click. It's a very famous way, it's a very simple way of remembering. One debit, one credit. This is when we debit and this is when we credit. Dead click. Let's see how it works in practice, because, you know, we can talk too much theory. It's accounting is a practical scenario. So a company receives cash. Who does it receive it from? The owners of the business, the shareholders, and it issues shares in return. Now this is one transaction, and it's one transaction has 2 effects. From the company's perspective, we've now got more money. So that's an increase in the asset. And what we've got is we've issued equity. We've got more resources from the owners. So the duality is that we increase the asset, increase bank, increase the equity, specifically share capital. Then we apply our debit and credit rules, and assets are debits. So we're debiting the asset, yeah, and we are crediting the share capital, £50,000. That little debit, DR is the abbreviation for debit. That CR is the abbreviation for credit. That's a convention. And sometimes people call that debit credit thing a journal. All right, a journal. It's the language or the jargon that's sometimes used. Let's have a look at another application. Again, a simple transaction. The company's buying a car, buying an asset. Doesn't pay for it though. Buys it on credit. £20,000. So you've got a sum of money, and we're buying it from Lucy. So this one transaction has 2 effects. And those 2 effects are to, well, the company's now got an asset, it's got a car, and the company now owes Lucy some money. So that's an obligation. So those are the two effects. An asset is going up and a liability is going up. And we call the asset a car, motor car, I don't care what you call it. It's describing the transaction. And we have a payable. We may as well call it Lucy. That's the person we owe the money to. What we're doing is we are debiting the asset. The asset goes up, so it's a debit. And the liability goes up, so it's a credit. Now, these are both examples of fairly simple transactions. But actually, double entry bookkeeping can be used to explain in shorthand the most complicated of financial transactions. So let's have a look at something which is more advanced. And this is not something you'd necessarily look at in your first year or even in your second year. The company's revalued an asset, which we're allowed to do. And it now has a value of 60,000. And it's been revalued by 10,000 in the past. So presumably we bought it for 50, we've revalued it upwards by 10, and it's now in the books at 60. But we can only recover 45. Now this is quite a complicated situation. The first thing to notice is that the asset is impaired, that there's a problem with the asset because it's in the books at 60, but we can only recover 45. So there's a loss of 15. We've got to write the asset down by 15. Okay. Now, if we're writing the asset down by 15, that is a transaction. No money changes hands, but the asset is coming down and we're recording an expense. So the impairment loss represents two things: an expense, yeah, which is a debit, and a decrease in an asset, which is a credit. So expenses and assets are both affected. Expense goes up, debit, asset go down, credit. Now it gets even more involved because the asset has previously been revalued. And so when we come to study the detail of ISA 36, the standard, it requires us to charge the loss to the reserve until it's exhausted. So we charge 10,000 of our 15,000 loss to equity, to the revaluation reserve, and then we charge the balance as an expense in the profit and loss account. And all of that is beautifully summarized in a short journal. So the debits and the credits are explaining that the measurement of the impairment loss is 15, where it's being charged. It is amazing. It's a very simple tool, but it's one that you'll learn at the beginning of your course. It's one that you carry through your career as an accountant. So yeah, that's great. If you're going to get good at double entry bookkeeping, it's not just about watching videos. Maybe you know how to swim. Maybe you know how to ride a bicycle. Maybe you know how to drive a car. You can look at YouTube videos to teach you these things, but you don't really learn until you do it yourself. So it's not really a question of practice makes perfect. It's a question of practice makes permanent. How do you get the knowledge that you've got superficially in your head that you understand? How do you get it into your brain? Practice. You practice swimming, you practice driving a car, then it becomes a lot easier for you. So let's recap on double entry bookkeeping. It's rules. It's rules. There are 5 elements: assets, liabilities, equity. Those 3 elements appear in the statement of financial position. Income and expenses, they appear in the income statement, measure profit. Duality, there are 2 effects. One transaction, 2 effects. One's a debit, one's a credit. And when do we debit and when do we credit? Remember, dead, click, dead, click. All right. So my name's Tom Clendon. I have spent 15 minutes teaching you, going over double entry bookkeeping. Thank you very much for listening.